Imagine waking up to find your entire investment portfolio slashed, not by a single bad day, but by a convergence of warning signs that few have ever witnessed together. Right now, the financial world is on edge as four critical danger signals are blaring in unison, a scenario so rare that the last time it appeared, more than $7 trillion evaporated from the markets. This isn't ordinary market turbulence, it's a storm with the potential to rewrite your financial future. For anyone with retirement savings, investments, or even a passing interest in the economy, the events unfolding now could determine your financial well-being for decades to come. The gravity of the current moment cannot be overstated. We are standing at the threshold of a possible market upheaval unlike anything seen in recent years. Do not underestimate what's at stake. The lessons from past crises are clear. Ignoring early warnings can lead to devastating losses. Stay with us as we uncover why these alarms matter, what history teaches us, and how you can prepare before it's too late. The decisions you make now could mean the difference between security and regret.
Before we go any further, let's get you involved. If you care about where your money is headed, make sure you're part of this conversation. Hit the subscribe button now so you never miss an urgent update about the markets. And I want to hear from you. Are you currently concerned about your investments? Drop a comment below and let us know what's keeping you up at night, whether it's volatile stocks, inflation, or fears of a looming recession. Your voice matters, and we'll be responding to as many questions as possible in the next video. By subscribing and commenting, you not only stay informed, you also join a community of people determined to protect their financial futures. Plus, the insights in the last part of this video could be the difference between holding on to your wealth or watching it slip away. So engage now. Don't let this moment pass by without taking action that could safeguard your financial well-being.
What makes this moment so alarming is not a single indicator, but the convergence of four powerful warning signs, each one serious on its own, but together truly extraordinary. Financial experts are calling this combination unprecedented, and for good reason. The U.S. stock market is exhibiting all four red flags at precisely the same time. We're not just talking about minor market jitters. These are the kind of signals that, in the past, have foreshadowed some of the most severe downturns in recent financial history. Each warning, outrageous stock valuations, a collapse in consumer confidence, soaring oil prices, and a decisive technical breakdown, has historically been enough to worry investors. But to see all of them flashing simultaneously, that's the kind of rare event that demands everyone's attention. The last two times this exact set of alarms sounded, the consequences were devastating. Understanding the gravity of this convergence is the first step towards making informed, protective financial decisions as we move forward.
To truly grasp the seriousness of what's unfolding, we need to look back at the last times these four signals aligned. In early 2022, a similar set of warnings appeared, and within months, the S&P 500 shed over $7 trillion in value as markets plunged into a deep bear cycle. But this wasn't the first time. In 2008, the world witnessed a financial disaster when stock values collapsed by over 50%, devastating retirement accounts and erasing years of wealth. Both of these moments were preceded by the same combination we see today: inflated valuations, collapsing consumer sentiment, surging oil prices, and a technical market breakdown. In both instances, the aftermath was brutal. Millions of investors saw their savings decimated, and many were forced to postpone retirement or face financial hardship for years. History doesn't repeat itself exactly, but these patterns are too significant to ignore. As we revisit these past events, it's clear that whenever these four signals collide, the consequences have been severe and far-reaching. That's why understanding the current alignment is so essential.
Let's break down what's happening right now and why it matters so much. The current market environment is a powder keg. We have record-high stock prices, a dramatic drop in consumer confidence, energy markets thrown into chaos, and a critical technical failure in market trends. Each of these alone would be enough to make professional investors nervous, but altogether, they create a uniquely dangerous situation. Unemployment is starting to climb, with the latest figures showing a loss of 92,000 jobs when experts had expected an increase. That's a swing of more than 150,000 jobs from forecasts, a shock to both Wall Street and Main Street. Economic growth has slowed dramatically, with GDP now barely above zero, signaling a stagnating economy. Inflation, meanwhile, refuses to subside and may even accelerate due to soaring fuel costs. The Federal Reserve is essentially stuck, unable to cut rates for fear of inflation, but unable to raise them without risking a recession. This gridlock leaves markets vulnerable to any additional shocks. In short, the data points in one direction: heightened risk and growing instability.
Let's start with the first major red flag: extreme stock market valuations. The Shiller-Cape ratio, a key metric that adjusts price to earnings for economic cycles, is currently hovering between 37 and 39. For context, the historic average over the last 150 years is about 17, meaning today's market is trading at more than double its long-term norm. This is not just expensive, it's historically dangerous. Only twice before have we seen the Cape ratio reach such dizzying heights. First in the late 1920s, just before the Great Depression, and then during the 1999-2000 tech bubble, when it peaked at 44 right before the dot-com crash. Both times, what followed was a devastating market collapse. In January 2026, the ratio hit 39.7, the second highest ever recorded. These numbers aren't just statistics, they're a powerful warning. When valuations are stretched this far, the market becomes extremely vulnerable to shocks, and history shows that steep declines often follow.
What do these sky-high valuations really mean for investors? Historically, when the Cape ratio is above 30, future stock market returns over the next decade tend to be flat or even negative. Right now, with the Cape pushing close to 40, the outlook for long-term gains is bleak. This is particularly concerning for anyone depending on their investments for retirement. Millions of Americans are in this exact position. The danger isn't just about a sudden crash, it's about lost time. For example, after the dot-com bubble burst in 2000, it took the S&P 500 nearly 7 years to recover its previous high. After the 2008 financial crisis, the wait was over 5 years. During those periods, investors not only saw their portfolios shrink, but also missed out on years of potential growth. With valuations as stretched as they are today, the risk is that even if markets avoid a crash, returns could remain disappointing for an extended period. This means it's crucial to be realistic about expectations and to plan accordingly.
Moving to the next major alert: the collapse in consumer confidence. The University of Michigan's Consumer Sentiment Index just recorded its third lowest reading ever, a level lower than at the start of any U.S. recession since 1980. This isn't just a number, it reflects a real sense of pessimism among ordinary people. When confidence drops this low, it signals that consumers are bracing for tough times ahead. People begin to cut back on spending, delay major purchases, and tighten their budgets. The ripple effects are immediate. Lower consumer spending leads to falling corporate earnings, which in turn puts pressure on stock prices. Historically, sharp drops in this index have either preceded or coincided with every recession over the past 4 decades. The fact that sentiment is now at such dire levels should be a wake-up call for anyone watching the economy. It's a clear sign that Americans are nervous about their financial futures, and for good reason.
Why does consumer confidence carry so much weight in the broader economy? The answer is simple. Personal spending accounts for roughly 70% of U.S. economic activity. When people feel optimistic, they spend more, businesses expand, and stock prices tend to rise. But when sentiment turns negative, spending dries up, businesses cut back, and the entire economic engine slows down. This is why every time consumer confidence takes a nosedive, it's quickly followed by falling corporate earnings and market declines. For example, during the Great Recession, consumer spending contracted sharply, which amplified the downturn and prolonged recovery. Today's low sentiment readings suggest Americans are pulling back on everything from vacations to home improvements. This collective caution can create a self-fulfilling cycle of weaker growth and more job losses. The impact is felt not just on Wall Street, but in everyday life, through fewer jobs, slower wage growth, and reduced investment. That's why tracking consumer confidence is so crucial for predicting where the economy is headed next.
Digging deeper into the latest survey data reveals just how widespread economic anxiety has become. According to recent polls, a staggering 74% of Americans now describe the economy as either fair or poor. That means 3 out of every 4 people believe the current environment isn't working for them. Moreover, 45% of investors are worried that inflation will remain uncomfortably high, while 37% are concerned about the weakening job market. These concerns aren't abstract. They translate directly into real-life decisions. Families cutting back on spending, investors pulling money out of stocks, and businesses holding off on new hires. Even though consumer sentiment doesn't always perfectly forecast recessions, every major downturn since 1980 has been either preceded or accompanied by a sharp drop in this index. The sheer scale of today's pessimism is unprecedented in recent memory, and it's already beginning to reshape economic behavior across the country. For investors and policymakers alike, these signals are impossible to ignore.
Host stands before a digital world map, highlighting the Middle East. As the recent conflict escalated, a sudden surge in oil prices sent shockwaves through global markets. This isn't just another price spike, it's the catalyst setting off a chain reaction across economies. When geopolitical tensions flare up in key oil-producing regions, market participants instantly react, fearing supply shortages. The current situation, with Iranian forces attacking infrastructure and shipping in the Gulf, has already driven crude oil prices to multi-year highs. These price jumps aren't just numbers on a screen. They translate to higher transportation costs, more expensive manufacturing, and ultimately, inflation for consumers everywhere. Airline companies are trimming flight schedules to cope with soaring jet fuel prices. Shipping firms are struggling as fuel expenses eat into profits. For everyday people, this oil shock means higher prices at the gas station and the supermarket. In past crises, such as the Gulf War or the 1973 oil embargo, similar oil shocks triggered global recessions. Now, as energy costs spiral upward, the world braces for the economic aftershocks. Oil remains the lifeblood of modern economies, and when its flow is disrupted, everyone feels the pain, no matter where they live.
The host now zooms in on the Strait of Hormuz, a narrow waterway responsible for transporting nearly a third of the world's seaborne oil. In March, an unprecedented military escalation effectively sealed off this choke point. Iranian forces have targeted tankers and critical oil infrastructure, causing international shipping traffic through the strait to plummet to historic lows. This isn't just a localized event, the ripple effects are global. With almost 11 million barrels per day suddenly removed from world supply, energy markets were thrown into turmoil. Emergency measures followed quickly. The United States and allied nations released 400 million barrels from their strategic reserves, the largest drawdown ever recorded. Yet, these reserves are finite, and experts warn this Band-Aid solution will lose its impact by mid-April. Gulf storage tanks are filling rapidly, pushing countries like Iraq and Kuwait to slash production. When storage maxes out, oil wells must shut down entirely, a logistical nightmare that can take months to reverse. Meanwhile, Qatar, a key gas exporter, faces severe disruptions after drone attacks crippled its infrastructure. The consequences reach far beyond the Gulf, affecting everything from fuel prices in Europe to fertilizer costs worldwide. The closure of the Strait of Hormuz is not just a regional crisis, it's a turning point for the global energy system. As oil prices skyrocket, the threat of a global recession looms large. The host points to a chart showing every major oil spike in the past 50 years and how each one preceded a sharp economic downturn. When energy becomes expensive, costs ripple through every sector, from agriculture and manufacturing to transportation and retail. In the United States, gasoline surpassed $4 per gallon in late March, a psychological tipping point that prompts consumers to cut back on travel and discretionary spending. Airlines are grounding flights, while logistics and delivery companies see their profit margins vanish. The International Air Transport Association had projected record earnings for 2026, but those forecasts have been thrown out as jet fuel prices more than doubled. Consumer inflation is surging, with the official U.S. CPI jumping to 3.4% year-over-year in March, mainly driven by energy costs.
If oil remains elevated or climbs further, inflation could soon top 4% or 5%, just as growth slows. The result? Stagflation, a toxic mix of stagnant growth and rising prices. Historically, such scenarios make it nearly impossible for policymakers to respond effectively. The world now faces a dangerous feedback loop. Expensive energy slows the economy, which reduces demand, but continued supply disruptions keep prices high. Investors and families alike must prepare for the real possibility of a significant recession triggered by this oil shock.
Switching to the charts, the host explains that technical analysis is flashing a major warning. The S&P 500 index has just fallen below its crucial 200-day moving average, a line that, for decades, has served as a psychological and algorithmic trigger for traders. When prices dip under this support level, it often signals a change in trend from bullish optimism to defensive selling. Quantitative funds, which manage trillions of dollars, are programmed to automatically reduce exposure when this technical threshold is breached. The last two times the market broke below its 200-day moving average, during the 2008 financial crisis and the 2022 bear market, massive sell-offs followed. Today, with so many institutional investors and trading algorithms watching the same signals, the move can become self-reinforcing. Selling begets more selling. The host demonstrates how sudden waves of automatic selling can quickly turn a minor correction into a full-blown crash. This technical breakdown, combined with deteriorating fundamentals like high oil prices and weakening economic data, dramatically raises the risks for investors. The market's loss of technical support is not just a chart pattern, it's a red flag that can accelerate a downward spiral in asset prices. Why does this convergence of warning signs matter so much right now? It's because today's markets are dominated by algorithmic trading and passive investment flows, which means that reactions to danger signals can be both rapid and overwhelming. In the past, markets might have taken weeks or months to digest bad news. Now, a single technical breakdown or economic shock can trigger trillions of dollars in automated sell orders within minutes. The current setup, extremely high valuations, collapse in confidence, surging oil prices, and technical breakdowns all happening together, creates a highly combustible environment. If one domino falls, the algorithms take over, amplifying every move. The host demonstrates how a sudden drop in the S&P 500 can set off a feedback loop. ETFs get sold, pension funds rebalance, and more selling hits the market. The risk is that what starts as a rational response can quickly turn into a panic-driven cascade, wiping out years of gains in a matter of days. This matters for everyone with retirement savings, college funds, or even just a 401k. The speed and scale of today's market reactions mean that by the time most people realize what's happening, the big moves are already over.
The host now brings all four warning signs together: extreme market valuations, collapsing consumer confidence, an oil shock, and a technical breakdown. Each factor alone is serious, but when they occur simultaneously, history shows they can trigger devastating market crashes. The last two times this exact pattern emerged, 2008 and 2022, investors lost trillions of dollars. What makes this moment unique is the interconnectedness of global markets and the speed at which events play out. The concentration of gains in just a handful of tech megacaps leaves the market especially fragile. If those leaders falter, the entire index can collapse. With energy prices surging and economic data deteriorating, even small shocks can have outsized impacts. The host illustrates how these factors interact. Falling confidence leads to lower spending. High oil prices squeeze corporate profits. Technical breakdowns prompt forced selling, and extreme valuations mean there's little room for error. It's a perfect storm where every weakness amplifies the others. The result can be swift and severe wealth destruction, leaving investors with losses from which recovery could take years. The message is clear. The concurrence of all four red flags is a rare and dangerous signal that demands attention.
Let's revisit the two most recent episodes when all four warning signs flashed together: the global financial crisis of 2008 and the bear market of 2022. In 2008, stock valuations were stretched, confidence collapsed, oil prices soared, and technical indicators broke down.
The aftermath was brutal. The S&P 500 fell by over 50%, erasing trillions of dollars in wealth. Retirement accounts were decimated, and many people had to delay their plans for years or never recovered. Fast forward to 2022, and the same dangerous cocktail appeared again. Valuations were sky high after the post-pandemic rally. Consumer sentiment tanked as inflation raged. Oil soared due to the Russia-Ukraine war, and key technical support levels failed. The result? Over $7 trillion in market value lost. Investors who bought at the peak faced steep losses, while even diversified portfolios suffered. These periods weren't just statistical blips, they were life-altering events for millions. The common thread? When these four factors align, the fallout is severe, widespread, and slow to heal. The host emphasizes the lesson: market recoveries can take years, sometimes nearly a decade, leaving those who need their savings most in a vulnerable position. The host asks, are we witnessing history repeat itself in 2026? All four alarm bells, overvalued markets, plummeting confidence, wheel shock, and technical breakdown, are ringing in unison once more. The pattern is eerily familiar, but the stakes may be even higher now. The world is more interconnected than ever, with technology amplifying every move and global supply chains more vulnerable. Mega-cap stocks dominate indexes, making the market more fragile to rapid swings. Economic data is deteriorating, energy prices are squeezing profits, and investors seem complacent, assuming the worst is behind us. The host cautions that history may not repeat exactly, but it often rhymes. If previous episodes are any guide, the market could face another deep correction, with recovery taking years. The lesson isn't to panic, but to recognize the setup. When these four forces align, the risk of a severe downturn multiplies. Investors, policymakers, and ordinary families alike must prepare for the possibility that, for the third time in 2 decades, we are approaching another major inflection point. The next few months could define the financial landscape for years to come. Turning to the latest numbers, the economic picture is deteriorating rapidly. The most recent U.S. employment report showed a loss of 92,000 jobs, a massive miss compared to expectations for a 59,000 job gain. That's a swing of over 150,000 jobs, one of the worst surprises in recent memory. Unemployment has crept up to 4.4%, and while that might seem modest, the direction, upward, is what matters most. Rising joblessness rarely pauses at a small uptick. It often accelerates as uncertainty spreads. Meanwhile, GDP growth estimates have been slashed from 1.4% to just 0.7%, barely above the threshold for recession. Inflation, instead of easing, is ticking higher, driven by energy and food costs. Moody's recession probability model now puts the odds of a U.S. downturn at 49%, just 1 point below the level that historically marks the start of a recessionary cycle. Weak labor markets, softer economic data, and persistent inflation create a challenging environment for households and businesses alike. The host underscores that these are not isolated blips, but signs of a broader economic slowdown. If the trend continues, the U.S. and the world could soon tip over into a full-blown recession with all the hardship that entails. The Federal Reserve now finds itself trapped in a classic policy bind. Host explains. On one hand, inflation remains stubbornly above the Fed's 2% target, driven higher by surging energy costs. On the other, the economy is clearly slowing. Job losses are piling up, and growth is faltering. If the Fed, under Chair Jerome Powell, cuts interest rates to stimulate the economy, it risks letting inflation get out of control. But if it raises rates to fight inflation, it could push the economy into a deep recession. The central bank is effectively paralyzed, unable to act decisively without risking severe side effects. Investors are watching every word from Powell and his colleagues for hints of the next move, but the reality is that there are no easy solutions. The host uses a scale to illustrate the impossible trade-off. Lower rates could fuel more inflation, while higher rates could choke off what little growth remains. Historically, such dilemmas have often led to policy mistakes, deepening the downturn. The stakes are enormous. The wrong move could prolong economic pain for years. Policymakers, markets, and ordinary Americans now face a period of deep uncertainty, waiting to see how the Fed will navigate this treacherous economic landscape.
Let's look at what the experts say about the chances of a recession. Moody's Analytics, known for their extensive use of artificial intelligence and data modeling, has updated their forecasts using real-time market and economic data. Their AI-driven model currently assigns a 55% probability to a U.S. recession within the next 12 months. This figure is up sharply from just a few months ago and reflects mounting concerns over persistent inflation, weakening consumer spending, and the recent shocks to energy markets. Moody's model incorporates variables like yield curve inversions, credit spreads, and global commodity prices. Notably, the model's recession probability spiked following the recent surge in oil prices and sustained weakness in manufacturing output. This isn't just number crunching. Previous iterations of Moody's AI model accurately predicted both the 2008 global financial crisis and the 2020 pandemic-driven downturn months in advance. While no system is perfect, such a high probability should serve as a wake-up call. Investors, businesses, and policymakers alike need to take these warning signs seriously. As history shows, these models often flag trouble before it hits the headlines. Now, let's shift to the energy shock that's unsettling the globe. The closure of the Strait of Hormuz, a vital maritime passage for nearly a third of global oil shipments, has sent shockwaves through energy markets. Europe, already struggling with depleted gas reserves after a severe winter, now faces even more acute shortages. Dutch natural gas prices have soared, nearly doubling to over €60 per megawatt-hour by mid-March. Countries highly dependent on Middle Eastern oil, such as the Philippines, are in crisis mode. President Ferdinand Marcos Jr. has declared a national energy emergency, warning that the country's crude reserves will only last until the end of June. In Asia, China has banned jet fuel exports to ensure enough supply for its domestic needs. Meanwhile, nations like Pakistan are rolling out measures like a 4-day government work week to conserve energy. New Zealand has tapped into its strategic petroleum reserves and is offering tax breaks to help families cope with rising fuel expenses. This domino effect is not just about energy. It's poised to disrupt industries, transportation, and even food supply chains worldwide, as fertilizer production is also tied to energy inputs from the Gulf.
Let's examine how these energy disruptions are hitting key industries. Aviation is one of the hardest-hit sectors. With China halting jet fuel exports and global oil prices spiking, airlines face skyrocketing operating costs. Many regional carriers in Southeast Asia are already canceling flights or scaling back capacity to cope. In manufacturing, factories that rely heavily on gas and electricity, especially in Europe and parts of Asia, are being forced to idle production lines or pass along higher costs to customers. For example, German industrial output has fallen sharply, with Chancellor Friedrich Merz warning of potential job losses if energy shortages persist. The chemical industry is also reeling, since much of its feedstock comes from natural gas. Shipping companies, meanwhile, are seeing fuel costs eat into razor-thin margins, with some operators suspending services on less profitable routes. The ripple effect is felt throughout supply chains. Delays, shortages, and cost inflation are becoming the norm. The combined impact threatens to slow economic growth further and puts millions of jobs at risk across the globe.
Now let's talk about how all of this hits ordinary people. The spikes in energy and transportation costs don't just stay in the boardroom. They show up in every household budget. As oil and gas prices surge, everything from food to household goods becomes more expensive. Supermarket shelves reflect this reality. The cost of bread, dairy, and produce is climbing rapidly, partly due to higher shipping and fertilizer costs. In some countries, food inflation has exceeded 15% in just a few months. For families already stretched thin, these price jumps are painful. Rent, utilities, and fuel for daily commutes are all rising. Central banks, like the European Central Bank, led by Christine Lagarde, and the U.S. Federal Reserve under Jerome Powell, are in a difficult position. If they raise interest rates to fight inflation, borrowing becomes more expensive and economic growth slows. If they hold rates steady, inflation could spiral further.
This tug of war means households must budget carefully, cut discretionary spending, and prepare for continued volatility in prices through the rest of the year.
Let's turn to another risk, the concentration of market power among a handful of tech giants. The artificial intelligence boom has led companies like Microsoft, Amazon, Alphabet, Google, and Meta to invest hundreds of billions in infrastructure. While these firms are enormously profitable, their current valuations assume relentless growth in AI and cloud services. If economic conditions worsen and companies cut back on IT spending, these tech titans could see revenues stagnate or even decline. This creates a systemic risk, as the largest 5 technology companies now account for over 25% of the entire S&P 500's market capitalization. When a few firms dominate, any downturn in their earnings can drag down the whole index, just as we saw during the dot-com crash and in 2022. Furthermore, smaller competitors find it increasingly difficult to gain market share or attract investment. This concentration not only amplifies volatility, but also reduces innovation and consumer choice, leaving markets more fragile and exposed to shocks. When markets stumble, one of the most important questions is, how long does recovery take? History offers sobering lessons. After the dot-com bubble burst in 2000, it took the S&P 500 a full 7 years to regain its last ground. Investors who needed cash during that period faced significant hardship. The 2008 global financial crisis saw a slightly faster rebound, but even then, the index needed 5.5 years to hit new highs. More recently, the bear market of 2022 bottomed out by October of that year, with a recovery to new peaks by early 2024, a relatively quick 2-year process, aided by massive government stimulus and resilient corporate profits. Yet, these events underline a critical reality. Market recoveries can be slow and painful, especially when starting from high valuations. Investors must consider not just eventual rebounds, but the emotional and financial strain of prolonged downturns. If you're counting on your portfolio for retirement or major expenses, waiting out a multi-year slump can be devastating. Past crises prove that while markets recover, the journey is rarely smooth or short.
The consequences of this crisis are not confined to one nation. They ripple across the entire world. European countries, still reeling from last winter's energy shortages, are now grappling with rolling power outages and soaring electricity bills. In Asia, economies like Vietnam and Indonesia face tough choices as fuel imports become scarce and expensive. President Luong Quang of Vietnam has ordered emergency rationing, while President Prabowo Subianto in Indonesia is fast-tracking renewable energy projects to reduce dependency on imports. In the Middle East, Iran's Supreme Leader Mojtaba Khamenei and President Masoud Pezeshkian are under pressure as sanctions compound shortages, while Saudi Crown Prince Mohammed bin Salman faces calls to boost production. The impact is also visible in Africa and Latin America, where rising food and transport costs are sparking unrest and protests. International organizations like the UN under Antonio Guterres and the EU Commission led by Ursula von der Leyen are coordinating relief efforts, but the scale of the crisis is testing their capacity. This global fallout highlights how interconnected economies are and how a shock in one region can trigger hardship everywhere. So, what actions can investors take in this environment? First, it's crucial to assess your portfolio's exposure to high-valuation growth stocks, especially those companies whose success depends on continued optimism about AI and technology. Consider reducing positions in sectors that are most vulnerable to energy price spikes, such as airlines, shipping, and heavy manufacturing. Instead, look for businesses with strong balance sheets, steady cash flows, and the ability to pass rising costs on to customers, a trait known as pricing power. Sectors like consumer staples, healthcare, and utilities often show resilience during turbulent times. Don't overlook the value of holding cash. In past crises, those with liquidity were able to buy quality assets at bargain prices when the market bottomed. At the same time, avoid panic selling. Instead of making drastic moves, rebalance gradually toward quality holdings and maintain a cash buffer for future opportunities. Finally, stay informed and flexible. Monitor developments closely and be prepared to adapt your strategy as new information emerges. Remember, risk management, rather than market timing, is your best defense when uncertainty is this high.